Good evening, everyone, and welcome back to another session of IBS Integrated Business Solution. As you all are already aware, that this is a case study driven exam, and as I mentioned earlier in the previous session as well, that this is not an exam, but this is basically a practical implementation of all the theoretical concepts that you have been through in during various subjects, various concepts that you have studied in various chapters of ICAI syllabus. So this is a practical implementation of all those concepts, and this is more or less like how the students, when they will become a professional, how they are supposed to handle clients, what kind of challenges or problems they will be coming across when they will start sitting in front of clients in those meeting rooms. So this exam gives you all those practical examples, instances, and helps you building that kind of an atmosphere whereby a practical kind of a client will be given to you, and then there are certain situations that client is going through. Those situations will be given through in terms of a question, and then there will be certain questions which are the objective questions and subjective questions, whereby these questions are the concerns or the problems that the customer is discussing with you. So they are generally a part of an industry. So the industry background is given to you through the case study, and then simultaneously, whatever the background of that particular client or that particular company in that industry. So those are given there. The decisions that they are about to take, that all is given in the case study, and that is simultaneously given you or presented you as a client background. In terms of the questions, those questions are something that the client is going through those situations as a problem, and then they need consultancy from you, advice from you. And as a chartered accountant, how you will be responding to that situation, how you will be drafting your response to the problems that the customer has come up with, or how you will do the value addition to the knowledge base or the know-how that the customer is able to gather from the open market. That is all is basically a practical implementation, and this exam is very practical in nature. Today, I'm going to take your IBS session, and in that session, in today's session, we are going to cover two case studies. Each case study will take around 1.5 hours, and we will have a 15 minutes of a break in between as well. Okay. These two case studies, which we are explaining today, will give you perspective of different industries, and then they will definitely give you insights on what type of industries are facing what type of problems, and as a consultant, as a professional, how you can respond or how you can handle them. So that's a kind of a background. When it comes to me, I am known as CA Amit Rathore, and I come with around 15 years of audit experience from Big Fours and the top 10 organizations, right? And with this, we can start today's session, and I'll be sharing my screen. We will start with today's case study number one. The technical team, somebody, can you confirm if my screen is visible?
Yes, sir.
Okay, perfect. So the first case study is about purchase on INC. So this particular company that is being presented through this case study, while going through the kind of background of this particular company, you will definitely come across, or you can definitely able to connect this purchase on INC with one of the very big giant, right? A US based giant, which has actually spread their wings across globe. They're presented in almost all countries in terms of the network, and this company is so big. So I'm pretty sure that while going through the case study and giving you insights around this particular company, you will definitely be able to recall or connect it with the actual company. The point is basically these case studies with a different name, they have already always represented the actual situation in the industry. These case studies are being taken from the actual industry by changing the names, and the problems or the situations that are given to you to solve as a professional, they are also generally those problems which these companies in that industry they are facing. So when we will go through the case study, you will definitely have better insights about this industry and about the problems that the industry is facing. We will then simultaneously solve the questions which are given at the end of the case study to give you better insights, more insights on how to respond to these kind of situations. Okay. So we are starting with the case study. The first case study for today is purchase on INC. This company was founded in 1992 by Rose Lee as an online bookstore. So there is an online bookstore which was opened by this one person known as Rose Lee, and then the time period was 1992. 1992, I'm pretty sure when we discuss about this, there is a lot of know-how or knowledge which is related to these particular years. If you guys are aware, then 1992 was the time when the dot-com bubble happened. You see, so that dot-com bubble was a bubble whereby there are a lot of people during 90s, early and late 90s, they started registering dot-com companies, and then they started showing a future plan, a strong financial modeling on the basis of which they started getting a lot of funding from the investors during that time. And what happened? Since this industry, the way we are dealing with like AI, ML, blockchain technology, cryptocurrencies, all these industries are pretty much new to the generation that we are part of. In the same manner, when in 1992, starting a company with .com and showing a financial model to fetch investment from the market was pretty much a kind of a common scenario. But what happened at the end of that particular decade, by the time 2000 came into picture, the industry realized that there is no adequate model to value these kind of companies, and that's why the most of the money that the investors put in the dot com companies, they ended up making huge losses. And in during this particular 90s, I mean, that's why this particular time period is known as dot com bubble as well in the history. And this, if you are aware, then this dot com bubble, and then thereafter, what happened was the Twin Tower blast and all in USA. And then thereafter, the impact of it is the reduction in the borrowing rates. And then, like people started buying the properties, and then suddenly the rates increased, and then there was a lot of defaulters of EMIs that came in picture. And this all was happening, and this ended up resulting in economic recession as well of 2008. And that was the time when all these things like Lehman Brothers happened and Enron scandal happened. I mean, this was a very crucial time period in the history of accountants, finance consultants, right? All the Sarbanes Act, Oxley Act, or the COSO framework, etc., is the product of this time only, right? And these were there so that these kind of incidents or these kind of situations will not occur again. This has some impact on Indian market as well. And if you can connect well, then there was a scandal, there was a scam in India as well that happened during that time, which is known as Satyam, right? So this Satyam was also a kind of a result because of the economic recession that happened in USA, and the economic recession that happened in USA. This dot-com bubble was a very big reason behind it. So this was the era, this was the time when there was a lot of people who were registering their companies, online companies, and coming up with the brilliant of the financial models, valuing their companies at the highest level. So during that time, there was a company which was started known as Purchase on INC somewhere in 1992 by Ross D. It has undergone a remarkable transformation into one of the world's leading technology company. Remember, something started as an online bookstore has ended up being the world's leading technology company. It was initially selling books only. Purchase On expanded its offering to include music, movies, and a wide range of consumer goods like books, electronics, clothing, household goods, and many more. So they started as an online bookstore, but they kept on and adding the product lines, which is basically the more segments of the products into that online store, which nowadays is pretty much visible with the store segments like music, movies, etc. It launched purchaseon.com in 1995. Okay, so this was the website with which they started. The website's name was purchaseon.com, and it was started in 1995 as an online bookstore offering millions of titles for sale. It achieved significant sales within the first month of operation, reaching customers across all 50 US states and 45 countries worldwide. You see, in 90s only, when they started 1992, they started a company, and in 1995 they started a bookstore. During that time only, what happened? They are able to achieve significant sales. Remember, this time was a very crucial in the history because it was the starting of the dot com. And during that starting period itself, people were really excited about using the services of dot com, and that this company came out as a very big beneficiary of that kind of a customer behavior change during that era. So when we are discussing about 1995, this company instantly got a kind of a very good response from the customers, and it was able to reach the customers to all the 50 US states along with 45 countries worldwide. It earned revenue of 13-14 million, close to 14 million in 1996. 1996, if you'll discount the I will say inflation and often the only marketplace that people use. Marketplace that the customers nowadays they are using. Saying this, you see, we have just gone through two paras, and as a let us suppose student of IBS exam, if I'll consider this, then there might be some information which is absolutely not relevant for the questions that will be asked at a later stage. By doing or going through the background is only to understand the industry, to understand the company it belongs to which industry, because there might be some questions which can be industry driven. Like, just to give an example, some kind of tax benefits are generally given to various industries. So you have to be very careful even when you are studying the general information about the company. It means, just imagine that cabin where a client is sitting. So if you are asking a client directly about their problems without knowing the background, it will be very difficult to address or to provide them the solution, because solution will definitely be dependent on which industry they are from and which company they belong, right? So while going through all this, my humble request or recommendation will be to keep highlighting all the key information, because in the examination there will be a lot of pressure and you will not get enough time, okay, to complete everything in terms of all the case studies that are given in the exams. You will not never have time to go through the case study again and again. So try to mark all the key informations in one go in your first study itself. Very important. Now, its diversification and innovations are done by expanding its product offerings beyond books to include music, movies, and eventually a wide range of consumer goods. The company introduced Jingly e-reader in 2007. So remember, there is an e-reader as well that this company launched now in 2007, and Millie Voice Assistant in 2017, pioneering new consumer technologies. It also ventured into cloud computing with purchase of web services. So they have a PWS as well in 2007. So in 2007 they started PWS along with Jingly e-reader in 2007. Despite initial skepticism in leading to substantial revenue growth and profitability. So initially there was a lot of skepticism around these services, PWS, e-reader, and the voice assistant. But later on, they become a very, leading. They led to the substantial or significant revenue growth. The company successfully navigated and adapted changes caused due to economic downturns such as the dot-com crash in 2001. Remember, I did mention that it was 2001 was the time when the dot-com bubble started happening. So in early 90s and till late 90s, companies were creating, I mean, there were a lot of companies who were created using this dot-com kind of a situation with a lot of, I will say, promises in the future with the highest of the valuation possible. And when people invested, everything got crashed in 2000. By early 2000, it was like a nightmare. So dot-com bubble happened. And the reason was basically because the economy was not ready. The professionals were not ready with any valuation technology or valuation methods to value these dot-com bubbles. Which at times nowadays when we are discussing that this AI, ML, blockchain technology, etc. maybe those kind of industry whereby valuing the right valuation of these companies can be a very big challenge because these are again a very new kind of an industry, and this resulted in the recession in 2008 and 9. I explained the whole step by step how it ended up or led to the recession just 5-10 minutes before. Though it maintained focus on long-term customer experience and innovation while streamlining cost and investing in key business areas like PWS. I'm really sorry. This is from the Big Four. PWS is this is the purchase on web services. PWS. Its strategic investments for future growth, expansion of PWS and advertisement business, providing advertisement services to other companies in the form of ads or sponsored products. It undertook a comprehensive review of business initiatives to prioritize long-term revenue and profitability. Its recent strategy shifts are towards closure of the physical store concepts to online web stores. It also emphasized on optimizing fulfillment center and transportation network to meet surging demand during the pandemic. It also, okay, perfect. Launch of purchase on business in 2016. So this business got introduced in 2016, catered to business procurement needs and drove $40 billion in annualized gross sales. It also uses advertising to promote its product and services. This includes ads in online and offline media as well as social media advertising. Okay, so they are heavily spending their money on the advertising. Just to give you kind of a little more insights about this particular company. So when then they plan to enter inside the Indian market, what I can recall, I read somewhere, is that the Indian market at that time when they were planning to enter India, it was not ready for the online stores or e-commerce platforms. So what they did, they actually holded their operations and then they let the market, the customer behavior change, let the market be ready for this kind of a platform. And at that time, if you can recall, there was other lot of companies like Flipkart, Myntra, they were heavily investing in a lot of advertisement and the marketing campaigns by bringing all those big billion-dollar sale or those kind of situations. You know what happened? The Indian market started becoming mature with those advertisements, with those marketing campaigns. They got habitual buying with the e-commerce platforms, etc. And once there was a maturity, the customer behavior changed towards the e-commerce platforms. This company came up with a very big bang and captured most of the market. So they waited till the time. I mean, patience was the key for them at that particular moment, but yes, they started heavily investing in the advertisement to promote their products and services. It ventures into new frontiers by entering into healthcare with purchase on pharmacy in 2021. So in 21, they came up with the pharmacy as well, followed by the acquisition of One Medical in 2022 to revolutionize primary care and the launch of Zoopier's satellite internet project to provide affordable broadband access to the underserved areas. You see, so what is happening actually, if you can understand the background of this particular company, they started with an online bookstore, but they have entered into multiple products lines, multiple service lines, right? Including pharmacy, web-based services. They are into music, videos. I mean, there is a lot that they are trying to do, and coming up with the the product diversification has been a very big strategy for this company to be successful. Understanding the customer need, customer requirements, and then linking them together to provide a bundle of services to the customers, which can solve almost all the concerned problems from a customer's perspective. It has been a very big key for them to be the successful kind of an e-commerce platform in the industry, showcasing technological innovations and social impact. It has a focus on long-term innovation. For this, it made investment in large language models and generative AI to enhance customer experiences across all business segments, and democratization of generative AI technology through PWS, enabling companies of all sizes to leverage advanced machine learning capabilities. Its technology offers various functions and tools to make Shopier easier for the users, such as personalized recommendations and search filter options. It also offers mobile apps that allow users to purchase products through their smartphones and tablets. So, this background that has been discussed or is mentioned for this particular company, there is, I mean, it is not like all the information which is given there may be relevant, like in our audit profession as well, when we discuss or we come across, we see with the client, there is a lot of information that is shared by the client. We come across lot of information, or I will say data. To be very honest, there is a lot of data that we come across, and then we have to get the information. We have to choose the right information from that data which is relevant for us. So in the same manner, when you will come across case studies in the examination, there is a lot of data which will be given to you by the examiner. What you need to do, you need to highlight all the information that is a relevant part of the data which you will be using for understanding and for responding to the questions that the client may have. Okay. Purchase on .com, and like how to highlight or how to do that. I mean, this is depending upon student to student, person to person. Some of you might be very much good with highlighting it inside the question paper itself, or making pencil notes, etc., over it as well. Some of you may start making some quick notes on the answer sheet itself, so that you need not to jiggle around or go back and forth again and again on the question paper. So purchase on .com diversified incomes are through various streams, including product sales. So this is very important. They have product sale income, subscription services. So they are providing the subscription as well to the customers. So subscription services there, advertising. It means advertising is not only an expenditure for the company, but they are able to sell advertisement space as well as a revenue stream. So the vendors which are there, this company is selling the advertising space to the vendors so that vendors can display their products for the customers who will be visiting on the website. So advertisement is also a revenue stream for the company. And cloud computing services like PWS, etc. So these are the services that provide stability and resilience against market fluctuations. So when there are a lot of market fluctuations are happening and the competitors are getting impacted, this company is able to have that stability because of these multiple streams of income. So they are into product sale, they are into subscription service, they are into advertisement and cloud computing services as well. Purchase on .com's activities revolve around product sourcing, logistics, technology development, and customer services. Remember, since this is an e-commerce platform, it is not only that you can give a beautiful platform to the customers to order, but they need to maintain, they need to fix the supply chain management as well. A customer's satisfaction does not only come by ordering products using a beautiful website, but how the product is reaching to them, whether this is coming within the delivery time that is allocated, and whether the shape and the form in which the product they are receiving that is good or not, right? So everything creates a definitely an experience for the customer, which leads to the success or failure of e-commerce platform. So in the same model, purchase on .com's activities, they are revolving around product sourcing, how to source the product, logistics, which is basically managing the supply chain, how the product that they have sourced from the respective warehouse or vendors kind of a shop, it will reach to the customer's hand. So that is the logistics. Technology development, which is basically the customer should anytime be able to know. I mean, there shouldn't be any gap in the customer know the kind of information that we are giving to the customers and the ground reality. And then the customer service, very important. The experience of the customer by ordering or by using the services of the company. So purchaseons.com's activities, they always revolve around how to source, how it will reach to the customer, what are the technology developments, and the fourth one is the customer service. Investments in fulfilling fulfillment centers. Okay, it is similar to like dark stores. What the dark stores are for the quick commerce industry. This is known as fulfillment centers. Delivery infrastructure, which I mentioned, logistics are very important. Owning warehouses, logistics centers, and automation technologies have enabled purchase on to streamline operations and offer faster, more reliable services to customers worldwide. And you see, these are some key KSPs, which is basically key selling point for the company. And because of all this, they are able to provide reliable services to the customers worldwide. The company offers a range of delivery options, including standard shipping, express shipping, and same-day delivery depending on customer's location and the product being purchased. So even in the delivery, when a customer wants a delivery, they have multiple options. So you can either go with the standard delivery, which is like if the product is generally made available in 3 days, then that is a standard delivery or standard shipping. Express shipping is even if it is available, let us suppose in 3 days, but you want it in one day. Then by making some extra payment, that standard shipping can be converted into express shipping as well, or maybe same day delivery. But it totally depends on where customer is located and what is the product that they are purchasing. It also offers delivery at a shipping address that may be different than the billing address. I mean, seems like it is not a very important service, but if you're a customer, you can understand how big or how important this kind of a service is. You see what happens if I'm sitting somewhere outside from my home. Let us suppose I am traveling. I am outside somewhere in some different city, in some different state. These kind of services, they are enabling me as a customer to order from the platform while I am, let us suppose, somewhere else, and it is delivered to some other place. Maybe if I am in a different city or state, I can still order from there, ordering it directly to my family. Or if I want to, let us suppose, send some gifts, something to some of my friend who is located in different city or state, that is very much possible with this kind of a service. So it's a very important service. They also offer contactless delivery, and the buyer is free to select the time frame within which delivery shall be attempted. So, like if you're an office going kind of official, it becomes very important to select the time frame. If the company is allowing you or giving you that kind of a slot selection method, it means you can select when the delivery will happen. I mean, it gives you some level of relaxation. So you can choose that this is the time when I'll be available at home, and if the delivery will be attempted, it has to be attempted within that time. So that facility is also that the company is giving. If you can clearly see, there is a lot that the company is doing by understanding the customer's behavior. They want the customer to be completely dependent on the services of the company, or the services to be so good that the customer will not think about the competitors. It offers goods services at lower prices in comparison to other company websites and traditional retailers due to lower cost for rent and personnel, right? So they are saving over here rental and personal costs, and they are using the savings by providing lower prices. It also provides free delivery services and access to streaming services to the customers upgraded by becoming members after paying subscription fees to buy with frame annually, quarterly, or monthly. So, if you can recall, above it was mentioned that they have multiple streams of income. So, one of the stream of income was subscription services. So, they are saying that if you have applied for a subscription of the services, if you have become a member by purchasing those subscription services, then the company may allow you to have the delivery without any delivery charges. Okay. In addition to the free delivery, it also encourages customers to leave reviews and feedback on product and delivery services to improve its product and services. So, company is asking the customers to leave the feedback. As a customer, whatever challenges or whatever opportunities I could see to have some improvements in the product or the delivery or the product packaging, whatever is there, I can give that feedback as well. And the company is going through that feedback to understand what are the challenges customers are facing, and then they are improving their services thereafter on. It also operates a customer service that is available via email, phone, or live chat. Customers can contact customer services if they have questions or problems, or if they need any assistance regarding purchase on product or services. Purchase On's resources include its extensive fulfillment network, proprietary technology platforms, purchaseon.com, PWS, and meeting, data analytics capabilities, and talented workforce. These resources serves as the foundation for Purchase On's competitive advantage and innovation-driven growth. PurchaseOn.com forged strategic partnership with publishers, suppliers, third-party sellers, and technology providers to expand its product catalog, enhance its platform's functionality, and improve operational efficiency. So purchaseon.com, they have made strategic partners. So who are the partners for the purchaseon.com? You see the publishers, the people who will be directly publishing for purchaseon.com, suppliers, the ones who will be supplying the products, material, etc., and then the third party sellers. You see, it is kind of a e-commerce platform where all the third party sellers can get registered and then they can sell their products, and technology providers to expand its product. And there is a lot of technical partners as well. You see, the company is investing in technology, in innovation, so they have to have the technology providers as the partners. So the company has partnered with a lot of publishers, suppliers, third-party sellers, and technology providers to expand its product catalog. They also entered partnership with courier service centers. Now you see, there is another kind of a focus area for the company was the logistics. How to make the product reach to the customer within the delivery time and in the right form and shape. So they have entered into partnership with various courier service centers, freight forwarders, and logistics centers that help in it to ship products to the customer. It also entered ventures with online payment services providers such as PayPayer and credit card companies to enable customers to conveniently and securely pay for their purchases. Its expenses are limited. Now we are discussing. So okay, so we are discussing about the focus areas. We have discussed about the streams of income. We have discussed about how they are customer centric, how they are learning from the customer behavior, all those things. Now we are talking about the second leg. Second leg is basically the expense. So we have discussed a lot of around the revenue. Now we are talking about the expenses. So when it comes to expenses, its expenses are related to fulfillment of technology development, marketing and content acquisition. So these are the expenses. So you see, the company is into music, into videos and all. So they'll not be only producing that music and video on their own. They will be buying or acquiring a lot of content as well. So they are the one of the biggest content acquirers, and this is one of the major expense in their P&L as well. So their expenses are the technology development that they are doing, the marketing that is happening, and the content that they are acquiring. These are the major expenses for the company. While investments in infra and technology initially resulted in operating losses, the purchase on its scale and efficiency improvements have led to profitability in its core e-commerce and cloud computing businesses. So any business which we are starting at such a large scale, it actually requires a lot of investments in infra and technology initially. And that is what results in the operating losses. And purchase on and company has also done that. But when we create a financial modeling, we definitely capture it like when the economy of scale will happen. And that's why you see when we are acquiring customers from the market, we don't call it an expense. We don't call it an investment. We don't call it like any other expense or loss. But it is considered in the business as the customer acquisition cost, right? Which is known as CAC in these industries. While investments in the infra and technology initially resulted in operating losses. So when we acquire customers, there might be some cost which is involved, customer acquisition cost, but later on with the economy of scale. So if generally you see the financial modeling that we do for a long-term financial plan, what happens, how a company which is currently in loss-making stage, how do we show that in the 5 years, 10 years down the line, they will be in profit. And this is the right way to show that the company, what they will do, they will definitely get benefited by the economy of scale. So if the operations, the size of the company, the operations of the company will increase, it will definitely result in the savings of the cost. You see, fixed cost per unit, it keeps on reducing, right? So you can understand that while the variable cost will remain same with the increase in the operations, the fixed cost per unit will keep on reducing. So that is one of the very big kind of a reason, or I will say a tool to show in the financial modeling that the company making losses today, it will start making profit in the long run. The second, which is the major important way of showing how the company can bring profit, is the product diversification, service diversification. So while I have spent a lot of money on acquiring the customers, the product or the current services that I am selling to the customers, it may incur certain losses, right? But once I am able to acquire a customer base, what will happen? I will introduce more products, I will introduce more services, and those products or services may not be available to the customers at the same discount with which the existing products or services are being sold. Since the loyalty, I am able to create some brand value by paying some expenses, making some losses, or incurring some customer acquisition cost. That loyalty can help my customers buying those products as well, where I have better margin. So these are the two very big things that can bring a loss-making company into profit, right? The first one is the economy of scale, decreasing the per fixed cost at a unit level as long as I'll keep on increasing the total sale. And then the second thing is basically product diversification, introducing new products with better margins with the same customer base. Okay, and the company is doing the same thing. So for this company, the expenses that we are talking here, they are technology development, marketing, and content acquisition. These are the major expenses. Purchase on.com. Policies prioritize personalized recommendations, responsive customer support, and hassle-free return policies. Its data-driven approach enables the company to anticipate customer needs and deliver tailored experience that foster long-term loyalty and satisfaction. So they are prioritizing personalized recommendations, responsive customer support, and hassle-free return policies. So they are thinking from customers' perspective. Like we have just read in the case studies that they have this mechanism whereby the customer is able to provide the feedback on the product or the services, and on the basis of that feedback, the company improves their products and services. Okay, purchaseon.com operates as a marketplace platform that allows third-party sellers to list and sell products on its website. If you can recall in the above kind of a case study, two paragraphs before, it was mentioned that they have partnered with the third party sellers as well. It means they are now an e-commerce platform. They are not an online store. Because they are not only selling their products, but they are inviting the third party sellers as well. They have asked third party sellers as well to register their products and sell on the website of the company. It collects fees from these sellers for services such as fulfillment, advertisement, and referral commissions. It also uses email marketing to send users personalized offers and recommendations and to inform them about new products and services. Revenue from third-party seller services includes fees, commissions, and other charges associated with facilitating transactions on the platform. Perfect. Now they have an Indian subsidiary. So this is the all of the background. I mean, this question is so detailed that if somebody is there who is interested in an e-commerce kind of a business, believe me, if you will understand whatever is written in this particular case study, this all is a summary of what the e-commerce platforms are doing to bring that customer satisfaction and revenue on the table. And each line has actually some very important relevant information for this particular industry, may not be relevant to you as a student, may not be relevant for the questions that will be asked at a later stage in this case study, but very important and very insightful for the industry that we are discussing here, right? So it's, that's another benefit by doing the practice of IBS kind of exams, and by doing the practice through the case studies that the ICI has given you through the case study digest, believe me, you will be able to get a lot of knowledge in respect of various industries. So it is highly recommended to go through the case study digest, which is available to you, right? It's not only waiting for these kind of sessions or struggling on your own to kind of figure out on how to write answers, etc. It's very easy to start going through the case study digest to get a glimpse in on how to write the answers as well, how to provide the solutions as well, and then simultaneously, obviously, it will help you enhancing the knowledge, which is very important at an industry level. Now the company has a subsidiary, an Indian subsidiary. Let's discuss about this Indian subsidiaries, that what is happening in India. Purchase on INC also owns online space for advertisement on internet and has agreed to sell such online advertisement space to Indian subsidiary for an amount of rupees 5 crore per month. So now the company has an advertisement space. If you can recall, they have a revenue stream as advertisement as well. It means they have a lot of advertisement space. If you go on any e-commerce platform, you will find there are a lot of products which are being displayed on the screen of the e-commerce platform itself. Those products are mentioned, given as a brochure, as a like banner. Those kind of things are available. All that banner space, all that kind of space to display your product, that is an advertisement space which is sold by these companies, and they are sold for the Indian subsidiary. The let us suppose if this is in US, so the US holding company has sold that space, internet space, to the Indian subsidiary in 5 crore rupees per month. So this 5 crore rupees per month is the expense that the this Indian subsidiary company is giving to the purchase ONINC. Like in the Indian context and from a professional background perspective, what happens? These kind of services are also subject to transfer pricing study. The space that has been given by the purchase ONINC to the Indian subsidiary, whether this 5 crore per month is actually a kind of an arm's length price or not. What may happen in these kind of situations, that let us suppose if purchase on an INC, they know that the tax rate is one of the highest tax rates in India, and it means if they will be earning more, there is a probability they will end up paying more taxes to the Indian government, and the purchase on INC may come up, right, with certain kind of expenses which they can book in the books of the Indian subsidiary so that the profits can be reduced, which will result in lower taxation. and the amount that they want to withdraw from the Indian market using this Indian subsidiary, if they will bill them with, let us suppose, 5 crore rupees per month for an advertisement space, then this 5 crore rupees payment will be, it has to be made by the Indian subsidiary, right? So what is happening in this given equation? These kind of situations will definitely have are subject to the transfer pricing study, so that the Indian government may not, India as a country may not end up losing some revenue. So just out of context and for adding to your knowledge. But yes, so there is an Indian subsidiary and they have purchased, there is support from that side, advertisement space from the holding company, and it is costing them 5 crore rupees per month. Now the Indian subsidiary, now since Indian subsidiary has this kind of a space and they are paying 5 crore rupees, so what will they do? They will further sell this advertising space to the customers. So what is happening now? Indian subsidiary sells such advertising space to the customers in India on its own accounts. Remember, these customers are not the end customers. Okay, these are the company's customers. So who are these customers? They may be the stores, those vendors, the third party sellers who are registered on the company's website. So if you are a third party seller, you have registered your products on the kind of an e-commerce platform. You want your products to be displayed upfront so that when a customer will visit these e-commerce platforms, they can purchase your product, right? So if you want that advertisement space to be used and your product to be placed over there, you will definitely pay to the e-commerce platform, and that will become a revenue for the e-commerce. It means you became a customer. So in this equation, Indian subsidiary, they are selling this advertisement space to its customers in India on its own account. The contractual arrangement for sale of such advertisement space is between the customer and the Indian subsidiary. So now you see the purchase on INC, they have already sold this advertisement space to Indian subsidiary. So when Indian subsidiary is doing a tie-up with the ultimate customer, then that agreement is only between the Indian subsidiary and the customer. There is nothing that the purchase ONINC has to do, because they have already sold that space in 5 crore rupees per month to the Indian company. Recently, Purchase ON has injected rupees 1000 crore into Indian subsidiary. So it means they have invested this much of money into the company. The investment aligns with the projected growth trajectory of India's e-commerce sector, anticipated to reach USD 230 billion. So this is the market size. By 2030, we'll be sitting around $200 billion of a market. So that is the purchase. On knowing this will happen, they have infused, they have injected 1000 crores with a steady annual rise of 20 to 22%. Earlier in February 2023, the US-based parent company allocated rupees 830 crores into the Indian entity. On 1st April 23, Indian subsidiary purchased an office block. Now this is another kind of an instance. So I was telling you, if you are a professional and this is a customer, this purchase ONINC, they will come to you, they will give you the complete background, and then they will tell you a situation. So let us suppose we are discussing this situation here, that on 1st April 2023, Indian subsidiary purchased an office block which is building for 50 lakh rupees and paid a non-refundable property tax. So they have paid a tax which is non-refundable and some legal cost to purchase this, which is 2,50,000 and 50,000 respectively, while acquiring the building in Bangalore. During the 2023, it redeveloped the building into a two-story building. Okay? So they purchased the building in 50 lakh rupees and then they converted it into two-story building. Expenditures on redevelopment were 1 lakh for building plan approval, rupees 10 lakh for construction cost. So redevelopment expenditures were, they got the plan approved in 1 lakh rupees, then they had a construction cost of 10 lakh rupees, but uh, in the 10 lakh rupees, the material or maybe services that they have purchased, there was 60,000 rupees of a tax which is refundable. So it means the expenditure is not 10 lakh. Maybe they have just paid the government 10 lakh rupees or the vendor 10 lakh rupees, but there is an amount of 60,000 rupees which they can get refund in the purchase in the taxes, and 40,000 due to abnormal wastage of the material and labor. And then they ended up paying 40,000 rupees for the abnormal wastage and the material labor. The redevelopment of the building, obviously, so this 40,000 is abnormal, so it will not be able to capitalize this, okay, with the building value, because it is an abnormal. So generally, the abnormal wastage, it has to go to P&L directly. You see, like surprisingly, but what is happening, if you logically you will understand. If you are spending some amount and creating a building, this building will give you 10 years of a benefit. Just to give an example, so you are dividing that expenditure you are doing today into 10 years, because there will be 10 years of economic value, and then you will be charging that expenditure which you incurred today during the 10 years time, which will be in the accounting books, it will be known as depreciation. But if there is anything abnormal wastage of material and labor, then we will consider that this is not a part of a building. Generally, if you will prepare a building, this expenditure will not happen. And if it is abnormal, you are allowed to take it to the P&L this year only. While if it would have been capitalized, then this 40,000 will be divided into the useful life of the building. It means that 40,000 of an expenditure will go in 10 years. Just to give an example, 4,000 rupees per year, increasing your profit for a particular year, right? Because then you will be booking less expenses. But since it is abnormal, you have to put everything in the current year's P&L. The redevelopment of the building was completed on 1st October 23. The entity rents out the ground floor of the building to its 100% subsidiary. So there is another 100% subsidiary, Rupee One. So what we did actually, Rupee On. This is the company, and we have given this first floor, ground floor to the building 100% to the Rupee On under an operating lease in return for the rental payments. So there is a lease agreement which is signed between the company and the 100% subsidiary. The subsidiary uses the building as a retail outlet for its operations, and the entity kept first floor for its own administrative and maintenance staff usage. Equal value can be attributed to each floor. Very important. Equal value can be attributed, and the company has two floors, ground and first floor. Ground floor is given to a 100% subsidiary, while the first floor is kept by the company itself. So just remember, if we'll talk about the standalone books, then for the company, the ground floor is basically a income generation source. It means this is not a property. This is an investment property. While the floor that the company is using for themselves is a property, plant and equipment (PP&E). Okay. The entity kept first floor. Okay. During the previous year, Indian subsidiary has launched a new range of in-house products with its long experience in clothes and accessories section. In order to promote its in-house brand products, Purchase On distributed gift vouchers to 100 lucky members with 5,000 rupees on 31st January 24. So there are some gift vouchers which are being distributed. 100 lucky members. This coupon can be redeemed against any purchase of in-house brand products made in future on purchaseon.com, let us suppose. So they have given 100 coupons of 5,000 rupees, which is 5 lakh rupees of a coupon to certain customers. But these coupons can only be used against the in-house products. They can never be encashed, or the amount will never be refunded. I mean, why refunded? Because the customer has not even paid. They are the free coupons that have been given. But yes, if customer will not utilize or use these coupons, then it is not going to be a expense for the company, because the customer has not turned out and the expense is not there. Okay, perfect. So with this, we have come to an end of this particular case study in terms of the background, etc. And then we can move to the multiple choice question section. I hope the whole of the case study is clear to you. When I actually studied this case study, this is given in 2-3 pages only, 4 pages, but it has actually a lot of insights about this industry. So I actually, while doing the research about this company, the background, and then whatever the information is presented, I got to learn a lot of things from this. So it is highly recommended that when you are reading, don't read like a student. You need to start behaving like a professional, because all this information, if not today in the exam, but tomorrow in the practical life, will definitely be going to be very useful. Okay. So going back to the first multiple choice question, the question is, which of the following statement best describes purchase owner's value proposition based on the provided information? Okay. The first one is basically the value. What is the value proposition basically? So there is a lot of information that has gone, and we know that the company is very customer centric. Okay. So we need to be yeah. Let me open these solutions as well. So we know that the customer centric approach is there, right? So we need to identify which one value proposition given out of all these four, talking about the customer relationships or about the customer centric approach, and then that will be the answer. Because like in the whole of the question, we have seen so much attention given towards the customer, be their feedback, be their kind of value addition points. Everything is being captured by the company to do the value addition in the services that they are providing. So, which of the following statement best describes purchase owner's value proposition? The first point is basically purchase owner's value proposition. It lies in its diverse revenue stream. Okay. So they are saying that the company is able to provide the diverse revenue stream. It means the customer can go there and then they can purchase from music to videos to books to anything else as well. They entered into pharma sector. So there is a lot that they are doing. They are into PWS mechanism. I mean, there is a lot. So they are saying the company's value proposition is diverse revenue streams. That is the first option. The second option says that purchase owner's value proposition centers around its key activities such as product sourcing, logistics, technology development, and customer services. So the company is focusing on these key activities, and that is a value proposition. Value propositions means for something, something for which the customers will keep on coming back, right? So they are saying the first one is basically the diverse revenue stream because of which the customers are coming back. The second one is basically the key activity focus that the company has. Third is purchase owner's value proposition is built on its extensive fulfillment network, proprietary technology platforms, data analytics capabilities, and talented workforce. So they are saying these are the value propositions. Fourth one is the purchase owner's value proposition focus on prioritizing customer relationships through personalized recommendations, responsive customer support, and hassle-free return policy. So, as I mentioned, as a customer, out of these four things, what is that one thing against which or for which you will keep on coming on the e-commerce platform of this company again and again? It is not that they are providing various kind of product, because the other platforms are also providing. It's also not like they are focusing on other these key areas. Everyone is focusing, right? It's also not like they have extensive network and all these things, but as a company, they are taking care of you as a customer, your relationship. They are providing you customer support. They are providing you hassle-free return policies and personalized recommendations. I mean, this is a very big thing that the company is doing. And as a customer, you will keep on coming back to the company for this value proposition. So the answer for this is D. D is the correct answer, which goes like this. We can read through the answer as well. So this is D is the answer, and the reason, even though you are not supposed to write the reason in the examination paper, but still, while going through these case studies, you may definitely come across these kind of reasons which can help you enhancing your knowledge. Purchase owner's value proposition is primarily centered around delivering exceptional customer experiences. The company emphasizes personalized recommendations, responsive customer support, and hassle-free return policies, all of which contributed to customer satisfaction and loyalty. Purchase owner's data-driven approach enables it to anticipate customer needs and deliver tailored experiences, enhancing the overall value proposition for its customers. This customer-centric approach is crucial for sustaining long-term relationships and driving repeat business, ultimately contributing to purchase owner's growth and success in the marketplace. So that is option D. Coming back to the second question, in the context of purchase owner's evolution from an online bookstore to a global technology leader, which of the following statement best illustrates the concept of business integration? So the question is asking, they were an online bookstore and then they became a global technology leader. So what do you think, which of the following statements they are best illustrating the concept of business integration? So what is about business integration out of these four options? So the first one is the purchase owner's revenue diversification strategy. So they are diversifying the revenue, okay, including expansion into cloud computing, healthcare, satellite, etc. So first is revenue diversification strategy for business integration. Second is purchase owner's investment in fulfillment centers, delivery infra. So this is second business integration, fulfillment center, etc. Third one is basically purchase owner's emphasis on personalized recommendations, responsive customer support and hassle-free, this all thing. And then they are saying this is the purchase owner's business in 2015. Entering into the business procurement needs exemplifies its effort to diversify revenue. You see, so when we are talking about the business integration, we are definitely talking about the all those expansions, cloud computing. So these are the various diversification strategies the company has come up with, and the answer is related to the strategy. The reason for this is basically that business integration involves the coordination of processes, systems, and functions across various departments or entities within an organization to achieve common goals. In the case of Purchase On, its evolution from an online bookstore to a global technology leader involves integrating diverse business segments and activities to drive growth and innovation. Option A best illustrates the concept of business integration as it highlights purchase owner's strategy of diversifying revenue stream by expanding into new business segments such as cloud computing, healthcare, satellite internet, etc. This expansion requires coordination across different departments and functions within the organization, including research and development, marketing, and sales. By integrating these diverse business segments, Purchase On demonstrates its ability to adapt to changing market trends and capitalize on emerging opportunities for growth and expansion. So the answer is basically option A, which is the how they are integrating the business by diversifying their revenue. Okay. Third one is select which of the statement is correct in connection with supply of vouchers in the hands of purchase owner to its customers. You see, so what is happening? They have given the vouchers to the customers. So the first one is saying that this is a taxable supply of 5 lakh rupees and this is liable in the month when they issued the vouchers. So obviously issuing vouchers will not attract any GST liability because it is not like a service has happened right now. You know what will happen instead? When the customer will redeem, then the GST will be applicable. Taxable supply of rupees 5 lakh liable to GST in the month in which the voucher is redeemed. So this is the second answer, that in the taxable supply in the month of when the voucher will be redeemed. Discount offered to members on the purchases made in the month of January and no tax would be payable. So it is not like no tax will be payable. Otherwise, all the companies will start issuing the vouchers instead of asking for payments. Discount offered to a member at the time of redemption of no taxes payable. So the correct answer is basically that taxable supply is there, but it will be a taxable supply in the month when the customer or member will come back. It will be redeemed in the month. So the answer to this is C. Sorry, B over here, which is the taxability in the month of when it will be redeemed. Now, what is the reason? The reason is as the supply against which the coupon will be redeemed is not known on the date of the sale of the coupon. So you don't know when or in which month the customer will come back to redeem the voucher. The time of supply of the coupon will be the date on which the member redeems it against in-house product of purchase amount. So whenever they will purchase is the kind of a period when it will happen. Let's move to the next question. How does purchase owner's practice of allowing customers to select their preferred delivery timeframe contribute to its strategic cost management? You see, the question is asking that the company is allowing customers to select their preferred delivery timeframe. So what happens? Let us suppose there are four customers which are sitting in the same area. Now, if the company is allowing all those four customers to select their preferred time slot, there is one way whereby the company may give them one time slot that one of the rider will come with the product of all those four customers, and this one rider will give the products to the customers in one go. It will definitely save lot of cost to the company. Otherwise, if four customers are ordering with different slots, the company may have to send the rider four times to deliver the products, which will multiply the delivery cost four times. Okay. So the question is asking that there is a strategic cost management that the company is doing. It means they are trying to manage cost, but simultaneously they are allowing the preferred delivery slot as well, which may be increasing the cost of delivery. So how this is getting fit together? Okay, you know what is happening by doing this, they are able to increase the customer satisfaction. So the customer will increase the demand. There will be more volume, and the better the volume is, as I mentioned, the economy of scale will be there because of which the benefit will be there. So out of all the options, A is by reducing shipping cost. It is not possible because if multiple deliveries will happen, shipping cost will increase. They are saying by optimizing warehouse utilization, again not possible. By minimizing inventory holding cost, not at all possible. But yes, by increasing the customer satisfaction and loyalty. So while the company is able to do this, the customer can select their preferred delivery slot. Maybe the competitors, they are not able to do this because they are not able to strategize on the cost or increase the volume so much that the economy of scale may come. So if that will happen, then the correct answer is that the company, this service of company is able to increase the customer satisfaction. Next question is, select the correct statement specifically in relation to sale of online advertisement space services provided by the purchase on INC to Indian services. You see, so purchase on INC has sold to Indian subsidiary the advertising space against which they were charging 5 crore rupees per month. And I told you this was subject to, yeah, just a minute. Sir. So fourth answer was D. We will go through the reason as well. The customer satisfaction, even though the reason is being already told. The reason is allowing customers to select their preferred delivery time frame enhances their overall experience with purchase on, fostering loyalty and increasing the repeat purchase, which in turn contributes to the company's strategic cost management by maximizing customers' lifetime value. Right? So this is how they are able to do this. Fifth is saying that the 5 crore rupees per month kind of a cost which is there for the advertisement space that is sold by the holding company to the subsidiary company. So the question is basically which statement is correct. The first statement is purchase on an INC is providing online information and database access or retrieval services and is thus required to register in India under GST and discharge GST on forward charge basis. So purchase on INC. If this has been true, I mean all the e-commerce platforms they have to register the ONC, their US holding companies, their European holding companies, Israeli holding companies, they have to kind of register. So this is not true, obviously. Purchase one INC is providing online information and database access or retrieval services electronically, and place of supply in such case is the location of supplier, which is outside taxable territory in present scenario. Therefore, no GST is payable on such services. Again, the service is there. There is an import of service that is happening. So if on the import of services, if the seller is not paying, then the buyer has to pay under reverse charge. So B is also not correct. C says purchase on an INC is providing online information and database access or retrieval services, and tax on the same is to be paid by the Indian subsidiary on reverse charge basis. This is what exactly I told you, that if the seller is not able to pay, the purchase on INC is not paying, then the import of the services. So this is the import of the services kind of a case, and the under reverse charge, the Indian subsidiary has to make the payment. Purchase on an INC is providing online information and database access or retrieval service, and tax on the same is to be paid by the Indian subsidiary in capacity of an agent. So they are not the agent, right? So the correct answer is basically C. Purchase on INC is providing online information and database access or retrieval service, and tax on the same is to be paid by India subsidiary on reverse charge basis. The answer to this is the reason basically that the sale of online advertising space is covered under the purview of OIDAR services, and this is the section of IGST Act. However, the service provider located outside India in case of OIDAR service is required to get registered under GST and discharge tax in India under forward charge basis only if the services are provided to a non-registered online recipient. In the present case, sale of advertisement space is made by Purchase INC to Indian subsidiary on principal-to-principal basis, and Indian subsidiary is a registered entity in India. Hence, even if the services are in the nature of OIDR services, the GST on such service is to be paid by the Indian subsidiary under reverse charge mechanism. This is the reason, basically. Again, reiterating, you need not to write the reason in the exam. The next descriptive question says, given the context. So there's a lot of information given about the company. Given the context, identify and apply the business strategic framework applicable to purchaseonan.com that effectively manages its resources, aligns its activities with customer needs, generates value for both customers and stakeholders, and positions the company for continued growth and success in the dynamic global marketplace. So the question is asking which one business strategic framework will work for all this managing resources and all. In the given question, since there's a lot of multiple factors which are involved, and the company is focusing on multiple areas, on what are the partners, what are the vendors, on the what are the customer needs, satisfactions, logistics. I mean, there's a lot which is going into technology, etc. In this given situation, the canvas model will be the right model. I'll just show you that what is a canvas model. Under the canvas model, the company may come up with multiple things. So this is the known as the business model of canvas. It shows that there are 9 things that you need to, as a company, need to focus upon. Right? These are the 9 things. Who are my key partners? As it was mentioned, the technological partners, their third-party sellers, etc., their suppliers, they all are their key partners. So they need not to, they need to write in the canvas, they need to mention that what are the key activities they are performing, what are the key resources they have, what is the cost structure they have, what are the various revenue streams which they are kind of coming up, what are the various channels, the customer relationship, their impact on the customer relationship, their strategies and all, the customer segments that they are operating in, and then what are the value propositions the company is giving. So all this is known as a business model canvas. So for this kind of an exam, and if they are asking this kind of a question, you need to explain this as a business model canvas, and then you need to write that under each of the parameter, what is exactly the company is doing, right? So this is the company. This is the demand of the question number 6. So if we go to the answer, the answer says, I'll quickly, first of all, give you an overview of the answer, that the purchase owner There are a lot of customer segments. So they are mentioning about all this, right? So I'll quickly help you go through that. Purchase owner follows the business model known as Canvas framework to structure its operations and drive growth in various business segments. It aligns with each component of the business model Canvas and followed a systematic approach to create a successful business model encompassing 9 key steps. All those 9 key steps which you just saw in the Canvas dashboard. The first one is the customer segment. So what are the various customer segments that they have? So you see in one of the situation, we are able to figure out that their third party sellers are also their customers. How are they their customers? When they are buying the advertisement space from the company. So they have the last, which is the B2B, when we are saying in that case, suppliers and the third party sellers can also become to the customers. So we need to mention what are the key customers segment. So we have individual customers, right? And then we have also subs, small business, retailers, manufacturers, wholesalers that want to sell their product, which is third party sellers, right? They also have connections with publishers and media companies which are using the platform like PWS, which we mentioned, and they are able to sell the content, books, etc. on the platform. So these are the key customer segments. That is the first a kind of a segment, first part of the Canvas framework. The second is what are the key partners. So the company, the question actually in the case study, it was clearly mentioned that they have sellers, they have logistic partners, right? Including various logistic companies, freight forwarders, they have payment partners, they have independent authors from whom they are directly getting the content published. So these are the key partners. What are the key activities the company is there? It is also mentioned in the question itself that the key activities are related to sale of products, logistics and deliveries, marketing, customer service, advanced technology, and IT infra. So this all is actually mentioned in the question itself. The value proposition. When we are talking about the value proposition, convenience. So value proposition is actually a multiple choice question as well, which was given above. So just mention some certain things about the value proposition. This is just a suggestive answer, so you need not to write the exact answer while you are going through the case study, and whatever you can come across in the respective part of the Canvas framework, you can keep on adding. Like in value proposition, what you will be writing. So all these things. Channels. Purchase owner utilizes services channels to deliver its products and services to customers effectively. So these are the channels. What are the channels? Web shop, mobile apps. This all is the channel. Customer relationships. How are they maintaining reviews, feedbacks, personalized recommendations? Revenue streams. There are a lot of revenue streams. Sale of products, services, advertisement space selling. Right? So all those things. Content, subscription model. That was the revenue stream. Key resources. What are the key resources the company has? So key resources describes the most important assets, online platforms, skilled software engineers or staff, delivery and logistic infra, purchase on brand itself is a very big kind of a key resource. Then we have cost structure. So how the cost structure is there, platform and services, key expenses, including the development and maintenance of website, apps, marketing and advertising costs. This all is the cost structure of the company. Right, so this is basically the Canvas framework. So if you come across any such question, what you need to do, you need to quickly open the Canvas framework and you need to write down in the total of the Canvas framework, under each segment of the Canvas, you need to write down that what is available in the case study. So you need to go through the case study and to pick the information, and then you need to fill the Canvas. This is what you need to do. The last question of this case study is discuss how the Bangalore building will be shown in the consolidated financials of the Indian subsidiary in their standalone financial statements according to the relevant Indian accounting standards and the consolidated. Okay, in the both consolidated and Indian standalone. So if you can recall, the Indian company had another Indian subsidiary, right? Indian subsidiary. So this particular subsidiary is a purchase on an INC's subsidiary, but they do have another subsidiary which is known as, to whom they have given the ground floor. Yeah, this is the name of the company, Rupee On. So they are saying for the Indian entity, if that Indian entity is there, and there are two floors, which one? One is the ground floor, which is given to my wholly owned subsidiary. The other one is the first floor, which is used by my company. So they are saying if that those two floors have been made with this kind of a cost, which is there given in the question, come up with how these two floors will be treated in the standalone books and in the consolidated books. So first of all, we need to come up with the total cost. So the total cost in the given question is basically this is the 50 lakh rupees, the initial cost. These are the transfer tax and the legal cost. So they will also be capitalized with the building. Over here, 1 lakh rupees of a building plan, this will also be capitalized. Out of this 10 lakh, 60,000 is refundable tax. So we'll not be able to capitalize this 60,000 rupees. Simultaneously, because they are the abnormal wastage, as I mentioned, the abnormal a kind of asset. So let's calculate the total cost of the building. First of all, purchase amount 50 lakh rupees, direct legal cost, which is 50,000 rupees. It means it will make them 1 lakh rupees. This one construction cost of 10 lakh minus 60,000, because 60,000 is refundable tax, 40,000 is there. Total amount to be capitalized on 1st October 23 will be 63. So total of 53 lakh, 1 lakh 54 and 940 is 6340. The question says that the treatment of the abnormal wastage and material and labor, as per Ind 16, the cost of abnormal amount of wasted material, labor or other resources incurred in self-construction of an asset is not included in the cost of the asset. It will be charged to P&L. That's what I had told you. If it would have been, let us suppose, a kind of a capitalizable expense, then this expense would have been taken into this 6340,000. And you know what would have happened? This 40,000 would have been depreciated along with the asset and in the useful life of the building. But since it is not a capitalizable kind of an asset, it will be taken to the P&L. It will become the 100% of 40,000 as an expenditure for the current year. Accounting of property building. Now, how the accounting will happen? So, when the property, first of all, the both the floors cost can be divided by 2 to come to the one floor's cost. So, for each floor, the cost is 31,70,000. So it says like when the property is used as an administrative center, it is not an investment property. It means if I am having a building and I'm residing or I'm using it for my business purpose, it's not an investment property. Okay. Rather, it is an owner occupied property. It means it is a simple property, plant and equipment. Hence, Ind AS 16 will be applicable. When the property, land or building is held to earn rentals or for capital appreciation, then at that time it will be investment property. So Ind AS 40 will apply. So if it is PP&E, Ind AS solar. If it is an investment property, Ind AS 40 will be there. Since equal value can be attributed, so for each floor, the total value is 31,70,000. As on 1st October 23, the carrying value of the building is classification would be as follows. So how this will happen? What will happen is basically that when we are talking about the standalone financial statements, in the standalone financial statements, this 31,70,000 rupees for the floor that the company has occupied, it will be PP&E under Ind AS 16. But this floor, the ground floor which they have rented out, right? That will be the investment property. Simple. So it so just read it quickly. In the standalone, the ground floor of the building will be classified as investment property. 4 rupees 31,70,000 as it is property held to earn rentals, while the first floor of the building will be classified as PP&E for 31,70,000. So this is the investment property and this is the PP&E. The PP&E, there will be a depreciation every year, and for investment property, it can be revalued every year to see if whatever the market value fall will be there, it will be recorded with that fall or gain, right? But when we are talking about the consolidated financial statements, what is happening in the consolidated financial statements? These both companies are the single company. It means even if the ground floor is given to the subsidiary company, it will not be like the rental income will be there, because the rental income which is paid to the holding company under the consolidation books, it will be eliminated, right? Because it is only one company. So when it is one company, it means we will consider that both the floors are occupied by the company. It means there is no need to account for one of the ground floor as investment property. So while in the standalone financial statement, we may have one floor as a your investment property and the other floor as a PP&E. In the consolidated financial statements, they both will be my PP&E. There will be no uh, standalone entities, right? Sorry. So they both will be my PP&E. There will be no investment property in the consolidated books of accounts. I hope mm, this case study made you learn something. There's a lot of new things that I was able to understand about this particular kind of industry. This e-commerce industry is a very fast growing and very important industry nowadays. You see, with the dot-com things that happened in 90s, the dot-com resulted into e-commerce platform as a new industry. With the e-commerce new industry and understanding the customer behavior, another industry came into picture recently, which is known as quick commerce industry. So e-commerce industry resulted in quick commerce industry, and then at a later stage you will realize that there will be some new industries which will come across. So as a professional, I mean, we need to continuously toil really hard to understand and to go through with this changes in the market, which is ever dynamic. I mean, it is changing significantly continuously. So we have to keep upgrading ourselves. So keep learning, and with this, we have come to an end of the case study one. We are going to take 15-20 minutes of a break, and we'll come back at 8:20, and then we will start with our second case study. So team, please announce it as a break, and see you at 8:20. Okay, welcome back, team, in the second section of in the second case study of this today's session. So I'll be just quickly sharing my screen and then we'll start going to the second case study. The second case study, if it is visible on my screen, for today the case study second, it is related to the smartphone market. So India's smartphone market, we will discuss today over here in this case study, and then what are the related challenges that any company in the smartphone market they are facing today, and as a professional, what kind of situations you may come across when you are a professional in this industry, and how to handle them. Simultaneously, we will also look into a very important model of customer behavior, of customer centric approach, which is run by these companies, which is known as Kano model, right? So we will spend some minutes on the Kano model as well today. So let's start with the case study. The case study it is for India's smartphone market. So how big the market is basically, if you'll consider, so India's smartphone market shipped 8 million smartphones in 2023. 8 million, which means 80 lakh mobile phones in 23, with a normal 1% growth year on year basis. So there is a 1% growth as well year on year basis. Market size was valued at around 170 billion in 23 and is expected to reach to 340 billion by 2030. Right? This is the kind of with the growth. This is what is we are able to predict. As per the International Data Corporation report dated February 13, 24. Now, Softtech Limited, which is STL, in the smartphone market. This is a Indian company, started its operations 3 years ago to manufacture smartphones and provision of IT software services. Okay, so we have a company known as STL in this industry, which has started operations 3 years before, and then they are manufacturing these smartphones. The objective of the company was to catch the market share of the growing smartphone industry, right? So they were able to see that there is a growing smartphone industry, and then they started operations to capture to that software industry. Now the STL company has entered into contract with its sole distributor MJN company. So there is an MJN company which is working as a sole distributor for the company in the North India to supply smartphone and software licenses. The software may be substantially customized to add significant new functionalities to enable the software to integrate with smartphone applications used by the customers. Okay, so what is happening? This MJN company is working as a sole distributor for the company, and which is into the business of supplying smartphones and the software licenses. The softwares that the company is giving, they are substantially customized. They are customized to add new functionalities to enable the software to integrate with smartphone applications used by the customers. The company also sells the smartphones and the software license separately to other distributors in the country. Customers can also buy smartphones and software license separately from other vendors in the country. So what is happening? STL, there is a distributor, MJN company, which is actually supplying the smartphone and the software license. But the company has a software enabled, which is basically can help integrating a lot of applications. And this is a software which is separately also sold by the company. It is not only like when a person is buying a smart mobile phone of the company, they are getting this license, but the company is also selling this license separately in the open market. So customers may buy the mobile phone, or if they want to buy the software, they can buy the software as well. STL has entered into a one-year contract on 1st April of current financial year with distributors MJ to deliver smartphone with customized software by offering discounted prices for certain volumes as per given. So now there is a one-year contract on 1st April of current financial year with the distributor, which is the sole distributor for the company. So STL has come to a contract to deliver smartphones with customized softwares by offering discounted prices. for certain volume as given here under. So price per smartphone. So the company is saying that we will give you a price of 10,000 rupees if you are able to sell 1 to 2500 the units. If the units will be there 2500 to 5000, we will give you 9500 rupees. If the company you are able to sell 5000 and above, the company will give you the smartphone at 9000 rupees. The problem or the confusion will be that the contract is for 1 year, so company may not be in a position at the starting of the year that what will be the ultimate price that the company will be able to fetch at the year end. So let us suppose the initial batch, let us suppose 100 units are being sold. So that an initial batch will be processed at 10,000 rupees per phone. But if at the end of the day, at the end of the year, the distributor is able to sell 5,001 units, then the initial price of 10,000, the goods that was sold beginning of the year in 10,000 rupees, the company has to reduce this as well, the amount as well to 9,000 and have to adjust it with the final outstanding. So maybe this can create some level of challenge. It's not a problem, just a mere challenge that the question may ask you with an professional advice. So volume is determined based on the sales during the financial year. There are no minimum purchase requirements. STL has estimated that the total sales volume to distributor MJ for the current year would be 4,000 units. So we are thinking that 4,000 units will be the price. It means we are expecting that we need to sell the product at 9,500 rupees. That's the ultimate target that we have based on its experience with similar contracts. STL company has estimated that 8,500 units of smartphones, including 4,000, which MJ, the company is predicting that 4,000 units will be sold by MJ. So company is saying that 8,500 units of the smartphone, including this 4,000 units, would be sold in the current financial year. So they are thinking we'll be able to sell 8,500 and with a market share of 1%, and the average contribution of 2,000 per unit will be achieved. So they are saying we will be able to sell 8,500 units and we will be able to capture 1% of the market share only with a contribution margin of 2000 per unit will be achieved. But remember, they have considered 4,000. If the distributor is able to sell more than 5,000 units, this price will reduce to 9,000. It means the contribution that the company have 2,000 rupees per unit, it may get impacted because of this reduction in price. Obviously, this 2,000 will not become 1,500 because of this 500 reduction, because this 2,000 contribution has come with 8,500 units, right? So it is not like that overall on an average 2000 contribution will be reduced with the same amount with which the discount will be given by the company, because the distributor has only a portion of the sales out of the total sales. It's not the total sales. Anyways, so to cut the story short, the company is thinking the distributor will be able to make 4,000 units sale, while the company will be able to make 8,500 sales with 2,000 rupees as contribution, while 1% market capture will happen. However, at the end of the current year, so now the current year end has come, the STL company actually sold 10,000 units. So they sold more units of the smartphone, including 4,500 units. So they were initially thinking that the 4,000 units will be sold by MJ, but MJ sold 4,500 units, and then they were able to achieve, instead of 8,500 and 1%, they were able to achieve 1.25%. So you see, it's not only so what must have happened actually, that the total number of phones that were sold in the market, which company was thinking that by selling 8,500 will be able to capture 1%, but they were able to sell 10,000 and was able to only achieve 1.25%. So obviously the total market size also differed than what we were expecting initially. So this is some insights around the market size. Recently, smartphone users have been experiencing issues with app crashes. So what is happening now? The users, so we were selling the software separately. So now the company has come across that there are users who are actually facing the app crashes as well, which has become a significant concern for the company. So company's concern is that the customer is um, kind of facing the app crashes. In response, the company is planning to enhance not only the operating system but also the touch screen of its devices. So the solution is that operating system and the touch screen, they both will be enhanced. By improving these aspects, the company aims to provide a more responsive and reliable user experience, potentially reducing the frequency of app crashes. The CFO of the STL company wishes to increase its market share to 2% in the next 5 years. Okay, so there was a kind of a situation that was mentioned that the user experience is getting worse or getting impacted because of the app crashes, and the company will be investing in the touch screen and in the operating system to enhance that. Okay. Now the company was able to achieve 1.25% of the total market, but our CFO, they want it to achieve 2% in the next 5 years. For this purpose, he wants to double the production of the smartphones for which additional funds are required. Bank is ready to finance for expansion of the smartphone operations of the company, but maximum up to 60% of the valuation of smartphone business. So bank is ready to fund because now they have to put more machines, or they have to invest in the market more to increase the market share to 2%. A bank is ready to give them a loan, but they will be only giving the loan of 60%, up to 60% of the valuation of the smartphone business. The CFO has been provided the following information of the company by the accounts manager. So there is a manager who has provided this kind of an information to the CFO, because CFO must be very interested in knowing that what is the total amount of loan that we can fetch. And because the bank has promised that the bank can only give you 60% of the valuation of the smartphone business. So these are the numbers. What is the number? The number is that the property, plant and equipment PP&E employed is 300 in lakhs, which means 300 lakhs means 3 crores. Okay. Working capital is 200 in lakhs. Equity is 200. The company is also having a 9% debt. So if you see, this is, let us suppose, if I'll look into the balance sheet, how the balance sheet is prepared. PP&E, which is fixed assets, is 300. Working capital, which is, let us suppose, debtors minus creditors, which is 200. Net debtors means. So this is the asset side, 200. Net debtors, 300 is fixed asset. Equity and debt, so this is the equity and this is the loan. So 500, 500 matched. This is the current balance sheet of the company. Corporate tax rates. My corporate tax rate is 30%. Risk-free rate of return. Risk-free return is 6%. Asset beta of the industry is 0.6. Market rate of return of the industry is 10%. NOPAT, net operating profit after tax for the current year is 200. Sales revenue for the current year is 1000. Okay, these all figures are in lakhs. Now you see, whatever the risk-free rate of the return is there and the market rate of the return, I need to consider my beta as well. So if the market in the industry, the market is, let us suppose, growing with a returns are impacted or affected. That is the beta for me. That how much is the diversion in respect to the industry returns. So we will look into it. I mean, how the value of this particular business will be calculated, and then the bank is ready to give us only 60% of the valuation. Okay, the PP&E is being depreciated at the rate of 20% per annum on going opening balances. The sale revenue and the NOPAT would grow at the rate of 20% per annum. For next 3 years, sales revenue will be stable. From fourth year onwards, an incremental capital expenditure will be offset by the depreciation. Okay. Asset PP&E and working capital turnover ratio shall remain constant all over the years. So they are saying this ratio will not change. Now, next thing is that JB Limited Canada holds 25% equity in STL company. It means JB Limited has invested 25% purchase by purchasing 25% shares in the STL company. Further, JB Limited has appointed 30% directors of the STL company, has advanced loan amounting to 25% of the book value of the total assets of the STL company of rupees 500 lakhs, and has guaranteed 20% of 25% of the total borrowings, that is total debt of 300 lakhs, which is mentioned above. Let's go through the facts again, because this particular these facts will definitely be asked in a question, and then we need to be very careful while reading through them, because our answers, our solutions will be dependent upon what is the percentage of guarantee or the total amount that is there. So JB Limited has invested 25% equity in the equity of STL. JB Limited has appointed 30% of the directors have been appointed, has advanced loan amounting to 20 company of rupees 500 lakhs, advanced loan amounting to 25% of the book value, okay, and has guaranteed 25%. So there is a, you know, see, 500 is the total assets. Out of this 500, there is an advanced loan amounting to 25%, which is given, and then they have guaranteed the 25% of the total borrowings as well, 300 lakhs. During the current financial year, STL company has sold 1,000 units of smartphones at the rate of 7,000 to JB Limited. Now you see, JB Limited, which is the holding the 25%, they have purchased 1,000 units of the smartphone at 7,000 rupees. Now you see, the same phones they were sold by the company to a distributor in with this particular rate chart. If you can recall, 10,000, 9,500, and 9,000, and the same phone was sold at a rate of 7,000 rupees, which is really close to cost. Because you see, the company just considered 9,000 as the selling price for this. The company is saying around 2,000 rupees per contribution will be there. So it means the net cost for the company will be somewhere around 7,000 only. So in short, it is like that the company has sold to the JB Limited, which is the 25% equity holder. They have sold them to cost. Seems like apparently 7,000 to JP Limited. The total cost, direct and indirect, for these 1,000 units transferred amounted to 6,000. So I mean, okay, so 7,000 they have sold, 1,000 may be the contribution in this particular case, or net profit, because this is the total cost. So I'm assuming it is being variable and the fixed cost both. So it is like 60 lakh is the total cost for these units, and the company has sold them in 70 lakhs. However, STL company built CD Limited India, unrelated to STL, at the rate of 9,500 rupees per unit of the smartphone, and earned a gross profit of 50% on its cost. So with this particular situation, the question is trying to tell you that the price 7,000 rupees which is charged from JB Limited it does not seem correct, because when company is selling the same product to an unrelated party, then they are selling it in 9,500 rupees with a margin of 50% on its cost, right? So these kind of situations may occur in the real life, because like the government is always considering, or even in a situation to consider, that there might be this JB Limited Canada, because of they are holding certain equity. That's why maybe that added advantage is being given to the company. So while the buyback of the same capital is not allowed, the STL company may be giving benefit to the JB Limited by reducing the price for them. The transactions of the STL company with JB Limited and CD Limited are comparable, subject to the following differences. It is very important. When the STL will be asked a question, why have you sold 7,000 rupees a mobile to JB Limited while the 9,500 was sold to the CD Limited? These are the reasons the company has given. Okay. The reason is STL company derives technology support. So company is saying that there is a technology support which JB Limited is giving them. Okay, but there is no such support from CD Limited. So it means that support, there is an extra support, and that support may be costing something. So the value of the support is estimated at 12% of the normal gross profit. It means it's 12% is the, so they are, even if they are giving 12% of the gross profit of a discount, then like we need to see where will they stand in relation to the price. So if we will discount as 9,500 rupees, let us suppose with the 12% of the gross profit. JB Limited gives business in large volumes. So there is a volume discount as well. So okay, so CD Limited may not have ordered 1000 units. Okay, while JB Limited is given a volume discount as well. And so the volume discount is around 8% of the normal gross profit. The third section says for supply of smartphones to JB Limited, STL company neither runs any risk nor incurs any marketing cost. JB Limited, since it's a known company, they have already acquired 25%. So company is saying that to sell to JB Limited, I need not to spend any advertisement or marketing cost. But to reach out to the CD Limited, I am spending 10% of the normal profit as a marketing function. So it means why I am selling at a higher price to the CD Limited, because I have to recover this 10% of the advertisement cost as well from CD Limited. And the fourth reason that they are giving is that STL company offered 3 months credit to JP Limited. The cost of providing such credit may be valued at 2% per month of the gross profit. No such credit was given to the CD Limited. So while in all three above kind of a situation, the price to the JB Limited could have been reduced. What will be the extent of reduction is something we will definitely calculate. But about three, all instances, they were suggesting us that the prices should be lowered down for JB Limited. But when we are talking about the fourth, which is D, and we are realizing that the credit was not given to the CD Limited, while the credit was given to the JB Limited. In this kind of a situation, we are clearly able to see that the price should have been higher for the JB Limited. So we'll definitely see that what is the gap or what should have been the price in the given situation. So this is the kind of a question. This is related to the smartphone industry. A very small question, I will say, but very important, because you see in this given kind of a scenario, these are the prices and STL's estimated prices, estimated volume, then the actual market, actual volume. Then there is a valuation of the business, because the CFO is expecting 60% of the valuation as the bank loan. We also have a kind of a situation whereby a product was sold and JB Limited invested and then given some guarantee, etc. And then the product prices are different for a unrelated market product company and a related company. So we need to see what is the net difference that we have. Okay. So these are a couple of things which are there. Let's go back to the questions, and we will clearly see that I mean how to write down the answers in the given kind of situations. So the first multiple choice question is, it goes like, determine which of the following statements correctly explain the customer's pains. So they are saying app crash, this is one of the pain. Touch screen technology is the operating system is the pain. Slow screen touch response is the pain. So if you can recall in the question, there were app crashes which were happening. To improve on the app crash cases, the company has invested in the touch technology and the operating system. Okay. So in the given situation, the answer will be, the first question's answer will be A, that is the app crash. So if you understand the app crash, that is the customers are experiencing issues with app crashes, causing significant inconvenience and leading to dissatisfaction among users. So this is the reason. The second question is, which I mentioned that while going through the particular case study, we will definitely be able to discuss and learn Kano model as well. So what is this Kano model? This is a model using the Kano model of the product development and customer satisfaction, which features does the touch screen operating system fall under. So first one is the performance attribute, second is the indifferent attribute, third is the threshold attribute, fourth is the reverse quality. You see the Kano model says that these are four types of attributes or qualities which a product should have. So whatever a phone or these kind of devices are presenting or offering to a customer, the all offerings can be divided either of the one of the categories. Either they can be performance related attributes, they are indifferent qualities, threshold, or reverse qualities. What are those things? Even though touch screen is a threshold attribute, because threshold attribute says that this is a bare minimum that a customer is kind of expecting from you. But I'll quickly make you guys go through the Kano model so that you can have a better understanding. We can spend 2 to 5 minutes on this so that if you will come across this kind of a question, then you will not struggle. I hope my screen is visible. Yeah, Kano model. What is Kano model? I'll not take much of your time. So we'll directly come that there are four attributes under the Kano model. The first attribute says performance, that the features under the performance model, they have to be like these features will increase the satisfaction. Okay, so whatever features you want to place here, write down over here in the performance sector, those will be the features which are more is better. Okay, so it means if I'll keep on writing certain features over here, the customer will keep on getting excited, keep on having better experiences. So it says that there are certain attributes which are known as performance attributes. It means the more is better. The when we are talking about the indifferent means the customer has, I mean, they don't care. They don't care about, let us suppose, just to give an example, that inside the mobile, the battery color is red, or it is yellow, or it is golden. I mean, the customer has is indifferent. They don't, I mean, it is not creating a difference for a customer. What do you understand by threshold? Threshold attributes are the attributes which are must have. So when you're talking about something, you are talking about that this is must have. Presence of this may not motivate customer or give a positive impression, but absence of this will definitely turn negative customer. So this is a must have. And then we have reverse. Reverse means too much of anything is harmful. So you may be thinking that this is an kind of a very good feature I'll be putting here, but that may result in a negative kind of an experience for a customer. I mean, at times, just to give an example, when we started thinking about Apple, initially, when I, couple of years back, when I used to use Android and I wanted to switch to Apple, and we started discussions, somebody told me that, I mean, the operating system of Apple, it is not user friendly. It is not helpful. The Google is more user friendly. You see, from that customer's perspective, if you see, having the iOS Android system, this iOS operating system, whatever way it was built, it was like a reverse attribute that the system was having too much complications or complexities that the customer was turning negative. To understand in a better manner, I mean, just imagine that you are staying in a hotel, right? So, if you are staying in a hotel, then the performance, which is the more is better. What are those attributes? They can be like faster Wi-Fi, larger room, better service quality. The more you will get them, the better you will feel. So each upgrade adds more satisfaction, guest reward, better execution. Indifferent means, I mean, you are absolutely indifferent. If they are there, it's okay. If they are not there, it's absolutely fine. It means wallpaper color. It doesn't matter which color of wallpaper is there. Decorative pillows on the bed, all those things. Guests rarely notice. Threshold is bare minimum. A customer cannot, I mean, absence of them will definitely turn the customer negative instantly. So, like clean room, functioning bathroom, basic safety, it has to be there. If it is not there, if it is there, I mean, then the customer may not appreciate it or may not write down in the feedback that this was there because this is bare minimum they are expecting. But if it is not there, they will instantly complain about it, right? Reverse means you are involving too many attributes which may become inconvenience for customers, like excessive check-in automations, complex smart room controls, right? So at times you will go in a five-star kind of a hotel and it will struggle on, let us suppose, opening a tab, right? They have multiple ways of opening tabs in different hotels, they have different ways. And if you are struggling at times, it is frustrating for you. It is like, they're just trying to make the things unnecessarily complicated or complex. So these are those are attributes. So in our question, if I'll go back to what we were discussing, about that using the Kano model of product development and customer satisfaction, which feature does the touch screen operating system fall under? So we are talking about the touch screen. Is it a performance attribute? It means the more is something that the client is keeping on appreciating. Not at all. I mean, touch screen is something which is bare minimum. If it is there, customer is thinking that it. I mean, what is a smartphone without a touch screen? So it is a threshold attribute. Okay. Third one is STL company provides the customer with software licenses that will be significantly customized and installed to make the customer function within the smartphone, bought by the customer from the company. Okay, customized and installed to make the software function with the smartphones bought by the customer. STL company also sells smartphone and software license separately. Determine whether the company has a single or multiple performance obligations under the contract with customer in accordance with the IND AS 115 revenue from contract. Okay, sorry, we missed the reason. So even though the reason is explained, I'll quickly help you go through, which is when these characteristics are met, they are taken for granted, but when they are not met, they cause a dissatisfaction. This is known as threshold attributes. Customer these qualities and regard them as basic, it is unlikely that they will mention the company will ask and get the feedback from the customer because they're bare minimum. Customer can't even recall this was there. Okay. So over here, company is saying that the company is selling the bundled kind of a product, which is the company's mobile plus software, and then the company is also selling the software and the smartphones separately as well. So the question is asking whether it will be a single or a double obligation for the company, right? As a single or a multiple performance obligation. So let's see what is happening. If you are selling it in a bundle, then it is a single obligation because you are not selling it to someone basically separately. So there is a bundle which is available. It is the customer. If they want to buy from the outside market, then also if you are buying a product, it is a single obligation. If you are buying a software, it is a single obligation. So first option says the company has two separate performance obligations. One is for the supply of smartphone and the second is supply of software licenses because they can be sold separately in the open market. But when they are getting sold separately in the open market, then they have separate obligations. Remember, the company has two separate performance obligations. One is for smartphone, and second is related. The company has single performance obligations for smartphone and software license because license is significantly customized to function to the smartphone. So it means this, there is a single performance obligation because you see, even if you are kind of sending or getting this maybe in a separate kind of a this thing, the answer will remain same. The single obligation is there. Even if you are buying the smartphone separately, the software is customized to run in that smartphone only. Okay, so there is a single performance obligation that the company has come across. Fourth is saying that the company has single performance obligation for smartphone and software license. They cannot be run in any other software. So let's go through the answer. The company has single performance obligation for smartphone and software license because license is significantly customized and integrated to function with the smartphone itself. What is the reason? The reason is the customer cannot use the smartphone without integration of software license. Okay. Okay. The fourth is basically determine market amount of market size variance and market share. For so there are two variances: market size variance. You see, I tell you that the market size is also changed, and that the market share has also changed. The company estimated that they will be able to capture 1% of the market share, but they ended up capturing 1.25%. In the same manner, they thought 8,500 unit sale will be there, but they ended up selling 10,000. So both market size and market share variance is there. How to calculate it? The answer is obviously A over here in this question, but calculation is what matters. So when you are talking about the market size variance, you see there are two things. One is the budget, the other one is the actual. When whatever variance you are calculating, that variance will be calculated between the actual and the budgeted, but the base will remain budget because the company is sitting at the budget. So if I'm talking about the market size variance, what I need to do, I need to calculate the market size, actual market size and budgeted market size. I need to multiply both, sorry, I need to reduce both of them to get the market difference. And then how much I was expecting as a my market share, it will become my market size share. So market size, first of all, we need to calculate the actual market size and then the budgeted market size. So you see, actual industry sale volume is 10,000 units I am able to sell, but I was only able to capture 1.25%. It means the actual industry units which are sold is 8 lakh. While when I budgeted that I'll be able to sell 8,500 units, but I budgeted only 1%. So initially at the beginning of the year, I thought the market is of 8 lakh 50,000 units, but actually the market ended up being 8 lakh units only. It means how much is the market size variance is there? The 50,000 is the gap. So 50,000 is the gap, and I was expecting what is my budget percentage? It was 1%. So that's what I told you. Always do actual minus budgeted, but keep on discussing or focusing on the budgeted because this is what I was thinking over here, right? So 8 lakh minus 8.5 lakh into 1% is my initial budget that I'll be able to capture this much of the. So what I did actually, because the market size reduced, I was able to reduce, or my sales got impacted 1% because market share was 1%. So negative 50,000 multiplied by 1%, and I am making 2,000 rupees of a contribution on each unit. So 10 lakh rupees of a loss is there. So my company incurred 10 lakh rupees of loss because the market size has fallen, has reduced than my expectation. So 10 lakh is the market size. If I'm talking about the market share, then market share variance is that I was expecting that I will have 1%, but I ended up getting 1.25%. It means this is favorable for me. So when I'm talking about the favorable, how much favorable it is? It is 0.25% favorable, right? Of how many units? 8 lakh units is the actual market. So 0.25% multiplied by 8 lakh multiplied by 2000, 40 lakh. So I was able to get 40 lakh rupees as favorable market share, but I lost 10 lakh rupees of the market size. Okay, so this is how you calculate the market size. I mean, when you read about the standard costing and all, pretty much common. These kind of calculations are being taught, or students are being trained in those kind of situations. Okay, now we're discussing about are STL Company and JB Limited Canada associated enterprises? If so, why? So remember, they are talking about associated. They are not talking about subsidiaries because the JB Limited invested only 25%, purchased only 25% of the STL company share. So the first option says yes, ST Limited and JB Limited Canada are associated because JB Limited Canada holds substantial equity, which is 25% in STL company, which is greater than 20% of the equity of the STL company. So this says that 25% uh, equity interest is there, which is 20% of the equity, more than 20% of the equity. Second option says STL Company and JB Limited Canada are associated since JB Limited Canada has guaranteed 25% of the total borrowings of the STL, which is 10 greater than 10% of the total debt of the STL company. Third says yes, STL Company and JB Limited Canada are associated because they have advanced loan amounted to 25% of the book value, which is greater than 10% of the book value. And fourth is saying that no. Right? So the correct answer is basically that they have given the more borrowings associated. So we will definitely go through the reason. Again, reason is not something that the examiners or ICAI is expecting you to write in the exam. So the answer is yes, 25% of total borrowings of STL, which is greater than 10% of the total debt of STL company. As per Section 92A, one entity becomes associated enterprise of another entity in any of the following cases. First is if one entity holds 26% voting power of the other entity. In our case, it is only 25%. So from this one kind of an instance, they are not associated. Second one is if one entity has advanced loan of 21% of or more of the book value of the total assets of other entity. In our case, it is 25%, right? Total borrowings. Third says if one entity has appointed more than half of the board of directors. What I can recall, it was 30% in our case, right? For an associate, it was only 30% of the directors. Yes, I'm right. So this 30% of the directors that the company has appointed. And fourth condition says if one entity has guaranteed 10% or more of the total borrowings of the other entity. 10% or more of the total borrowing. So in our case, they have given 25% of the total borrowing. So associate. STL. So we are moving to the descriptive questions now. Question number 6 says STL has actually sold 2000 units of smartphones to distributor MJ for half year ending 30th September and has sold 45 units of smartphones for the current financial year ending 31st, has sold 41. Okay. Determine the transaction price and the amount of revenue to be recognized by Softech Limited for the half year and for the current year with Ind AS 115. Necessary general entry should be recorded in the books of STL for the current FYI. So what has happened, if you can see, this was the kind of a range. So until you are crossing 2500, the company will be charging 10,000 rupees, right? So in the given situation, what happened in the initial 6 months, the distributor was only able to sell 2000 units. So the company must have booked all 2000 units at 10,000 rupees, right? Booking the revenue. But later on, what happened? By the time the time ended, the year ended, the distributor was able to sell 4500 units, which means the price should be reduced by 500 rupees to 9500 rupees. So what happened? The initial 2000 units, which was sold at 10,000, their price will also be reduced. So 2000 into 500 is something that the company should do at a later stage. Because initially the 500 rupees of a discount has to be given. So they cannot recognize the revenue for that. So in this given situation, let's see how we have done that. Transaction price. The transaction price is 9500 per smartphone based on the best estimate of the total sale volume of the 4000 units for the current year distributed to MJ. Recognition of revenue will be recognized at a selling price of 9500 rupees per smartphone sold. For the half year ended 30th December, STL company shall recognize revenue of 190 lakhs, though they will charge rupees 10,000 per unit. Okay. So it means what will happen? So they will charge 10,000 rupees from the customer, but this 500 is a provision that they will keep on. So for the whole current FY, STL shall recognize revenue on actual sales basis, which is 4500 unit into 9500 rupees. See, the next is recognition of liability for the half year ended. STL company shall also recognize a liability which is advance from customer for excess price realized amounting to rupees 10 lakh, which is 2000 units into 500 rupees. 30th September. So what is happening over here that there is an estimation as well, right? The company initially thought that STL will be only able to sell 4,000. So when the company is already decided or have an understanding that company will be able to, the client will only be able to sell 4,000 units, then they know that the price somehow will be somewhere around 9,500 rupees. So when then initially they will sell 2,000 units, because the initial 2,000 units has to be booked at 10,000 rupees. When they will charge customer 10,000 rupees, they will not book the revenue at 10,000 rupees. Instead, the 500 rupees which is extra they are receiving from the customer, it will become a customer advance. Okay, this is how it is. At a later stage, that customer advance will be adjusted with the final amount, final sale that they will be making. So on 30th of September, which is the first half year ended, what will they do? They will recognize bank or receivable account, whatever it is. This is 2000 multiplied by 10,000, but they will book the revenue with 9,500 only, which is this much. The rest they will put in the advance from customer as a liability. On 31st March, what will happen now? Bank or receivables account 327, 50,000 advance from customer, because now they will adjust this advance from customer as well. Sales will be total 9,500 multiplied by 4,500. So this is the total sales. But out of this total sales, we have already received an advance from the customer, which is 10 lakh rupees, and the remaining will be booked as a bank or receivable. Okay, so this is how they will do this. Question number 7. Determine the amount of the bank finance available for expansion of operations for the smartphone. So they are saying now calculate the value of the business, and then simultaneously along with the value of the business, how much is the loan or the finance will be available to the company for expansion purpose, right? So we need to understand that in the given question, first of all, let's see how much is the so computation of the bank finance available for expansion of the operation, calculation of the depreciation on assets, PP&E and working capital. Okay. So opening balance of the PP&E in the first year, in the 0 year, there is nothing. So in the first year, they are investing 300 rupees. Depreciation will be 20%, right? This will keep on increasing 20%. So this will keep on increasing till this stage, and the depreciation impact will be considered. After the depreciation impact, the balance will be 240. The additional purchases during the current year is 120. So this will become the opening balance. This is how you will calculate the future cash flow. Closing balance of the PP&E at the end, and then sales is this much with the growth. These are the numbers that will be there. Okay. Calculation of free cash flow from expansion of operations of the smartphone. How much it will be available? Net operating profit is 240, and this is increasing to 88, 345, 345.6. Depreciation is there, which is like we are discussing about the cash flows. So depreciation is a non-cash item. Then increase in the PP&E, because now this is an investment. This was here 120, 144, and 172, because this will reduce my cash. And there is an increase in the working capital. So this is the increase in the working capital which is required. Okay, and this is how it is calculated. This is 240 minus 200, 288 minus 240, 345 minus 288. So it means for the year 1, year 2, and year 3, how much free cash flow is available with me? It is 140, 168, and 201, and 346. Calculation of the weighted average cost of capital. We have equity beta, asset plus debt minus equity ratio after tax. So equity beta is 1.23. It is calculated over here. Right, debt equity ratio 1 minus taxation, which is 0.6, 1 plus 1.507, 1.23. Cost of equity is how much? Cost of equity plus my equity beta, which is I have calculated above, and these are the difference. So this is my cost of equity. What is the cost of debt? It is 0.5. 9% multiplied by, so I will multiply this 40% is 10.92. So I'll be able to calculate my WACC, which is weighted average cost of capital, 8.148%. So for my company, I'm sitting at this particular rate of cost, which is my cost for equity and for debt, both. Calculation of total valuation of operations of smartphone. So how the valuation is, how much free cash flow I have. So I have 140, 168 and 201, 140, 160, and this is how much I have. Terminal is 345. Let us suppose I'll keep on having this 345 till the time of infinity. If I'll keep having this, then if I want to know the value of the terminal kind of an amount, if I'll divide this with the weighted average cost of capital, I'll get the complete infinite amount that in the future, how much I'll keep on kind of getting. And this is the total amount that I'll be getting at the end of the third year at the last stage. Then this is what my capital cost of capital. If I discount this after first year, this is the discount factor, discounting factor. After 2 years, discounting factor. At the end of the 3 years, this is my discounting factor. And if I multiply this first year's cash flow, second year's cash flow, third year's cash flow, and then the cash flow will be there, I mean, till infinity. And I'll discount that to my respective years, then this is the amount. And these are the total, the present value of 3788. The bank has told that they can give us 60% of the loan. So 60% of 3788 is 2273 lakhs or 2273. Yeah, see, so there is a lot of factors that have been into this particular situation. But what we did is actually first of all we calculated the simple free cash flows that we have, right, for respective years. So the free cash flows is the first thing. The second is basically I have calculated a weighted average cost of capital. I know the free cash flows. I know the weighted average cost of capital. On the basis of both of them, I have calculated the total valuation. And on the basis of total valuation, the bank is giving me a loan of 60%. This is the question. I mean, these are a couple of pretty complex questions, I will say complicated questions, and they gives you very good insights. They enhance your knowledge to a great extent if you keep on going or doing practice of such questions. So a case study, going through a case study does not only help you with the theoretical kind of concept clarity, but it can also give you practical insights and can definitely increase or enhance your this kind of technical aspects as well. The last question is basically compute the arm's length price as per section 92 along with income to be increased current financial year of Softec Limited under the cost plus method for the transactions entered into by the Softec company with JP Limited. So when we were going through that situation, I told you that the price difference of 7,000 to 9,500, right? This can be the reason the company is telling us that this A is the reason because of which they have given a discount to the GP Limited. B is the reason again the discount. C is again the reason of discount. Fourth is basically if you are giving a credit, then you have to kind of add this. It should be a premium. And if you'll adjust all these four things, then the price at which the company should have sold it to the JB Limited, that will become my arm's length price. That this 9,500 will be adjusted with these four things, and the price, whatever it will be, it will become my arm's length price. So let's see how we are going to adjust it. So you see the gross profit markup on the cost in case of CD Limited and unrelated party is 50%. Company is saying that they have made 50% of the gross profit. So they are saying the first one is the value of the technology. This is 12% of the normal gross profit. Okay, they are saying you can consider this as the 12% of the normal gross profit. So they are saying value of the technology support, JV Limited provides technical support. Therefore, value of technology support shall be adjusted. So 12% of 50%, it means 6% is the discount that the company can definitely give. In the same manner, if the quantity discount is given, then 8% is there, 4% can be reduced. And then while STL limited for this, 10% is there, risk and cost associated with marketing. It means the marketing expenses are not there in case of JB Limited, so we can definitely earn more. So this is 5% is also here. So if I'll adjust this 50% of the GP ratio, then this will become 35% of the GP ratio. In the same manner, if I'll discuss about 2% of the monthly interest rate is there, and I have given an advantage to the company, then this 3 months will interest will become 3%. 1% multiplied by 3%. So arm's length gross market profit markup for this particular case is 38%. So while the company has made 50% on, let us suppose, this one company which is unrelated, if I will adjust the gross margin, then the company should have made at least 38% on this particular sale to the JB Limited. So cost incurred by STL for JB Limited is 60 lakhs. Adjusted gross profit, it should be 60 lakhs, 38%. Company should have made at least 38% gross margin. So it is 2280 lakhs. Arm's length bill value should be 82 lakhs, while the actual bill is 70,000. So increase in income of the STL. So the department will push them that their actual revenue should be 82 lakhs. It means the correct price at which the goods should have been sold is 8,280 rupees in comparison to 9,500 rupees to an external party. Or they have to justify it by coming up with more reasons that why the price transfer pricing valuation method. So we have done that adjustments of all the benefits that are there, and then we have adjusted it in the gross margin, and we calculated the arm's length price. So this 12 lakh 80,000 rupees of an additional income will be there, and then the company has to pay the taxes on this. Okay, perfect. So I think we have covered two case studies today. One is the online e-commerce, which is more or less basically a e-commerce giant, and the second we have completed in the mobile division. So both of the case studies have given us more insights, good insights about the industry. With this, we have come to an end of today's case study session. I thank you all for attending today's session, and I look forward to discuss more case studies in upcoming sessions with you guys. Thank you everyone, and good night. Have a great weekend. Take care. Bye.
Session
Team,
over, sir.
yes, session is over. We can call it a day. Thank you, team,
Thank you,
for your.
sir.
Thank you. Bye, team.
Also,